Friday, August 11th, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at inflation. We're going to look at the central bankers and government's 2% target, which seems crazy. And I'm going to tell you what they don't want you to know about this target. And I'm going to show you how in the last 34 years or so, inflation has actually hurt the bottom 90%. It favors, of course, the very wealthy because they're able to protect themselves because they've got more assets and they can invest those assets while the bottom 90% continues to struggle. And I'm also going to show you the way to not have inflation. Yes, it's very simple. It's not rocket science, but unfortunately, it's something that many might think is radical, but it really isn't. So, before we go into the topic of inflation and the CPI, I just wanted to say that the Mike and Mario show will be back in the first Friday of September. I spoke with Mike yesterday, and yes, he said he's been getting a lot of flack from his followers, and a lot of you have been asking as well about it. The Mike and Mario show is with Mike from Rethinking the Dollar, and we do it every Friday at noon Eastern Time or 5 p.m. London time, and we do it live. So I'm gonna play a little clip, and this is someone tweeted this out, and this is Jay Powell. I think is testifying in Congress, answering questions, and just let you listen to this.
For the general public, for those working families, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another. How
does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not, it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because, you know, the evidence is the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. You know, if everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So
there you go. Basically, Jay Powell, of course, has no clue about what inflation is, or he's hiding the fact that inflation really is is theft. And I'm going to come to that in a minute. But I would say he's probably ignorant of what inflation is, mainly because he was trained as a lawyer. Even if he was trained as an economist, modern day economists look at inflation as CPI, and they think that inflation has to go up by 2%. And they don't understand sound money and the fact that we don't need central banks, because central banks are a tool to help the government inflate. And as Felix Sommeray once said, the Raven of Zurich, that inflation without government or against government is impossible. So it's the government and the central bank that create inflation. So now I'm going to show you why this 2% target is actually bad for the public. And this person that asked the question, she's right. And the argument from Powell and his cohorts is that if you let prices go negative, it's going to create a depression. The fact that you're able to buy more, right? So now what I'm going to do is show you a chart of the CPI, but not the percentage numbers that we see every month published. Yesterday it came out at 3.2% year on year, the CPI. I'm not sure what the month on month number was, but what that does is that detracts your attention from the index itself of the CPI, which is just like the Dow Jones index. It's measured as an index, but they don't want you looking at that. And why is that? Well, because you will see why 2% becomes a problem, or any percentage, right? So, and I'm going to go back to 1989 here. So if you look at 1989, and this is in the beginning of 1989, the consumer price index was at 121.6. So I've got my Hewlett Packard here. So if you do 121.6 times 2%, you get $2.43. So let's say that CPI in 1989 to 1990 was 2%. Well, you would need an extra $2.43 to buy the basket of goods in the consumer price index. And I think back then, actually, the CPI grew a lot more, but I'm just using 2 as an example. So now let's go to the 2008 year, which is when we had the of course, the great financial crisis. And I'm going to the beginning of 2008, and we've got the CPI at 219.96. So we use 219.96, 2%. Well, we're up to $4.40. So that means if the Fed was running a 2% target and CPI was 2%, in 2009, you'd need $4.40, a lot more than you needed back in 1989. So let's look at the present number. Well, the present CPI index is 305.69. So let's do the maths. So now you're going to need $6.11 in a year's time if they keep a 2% CPI target. And this, of course, is not even looking at how they've tinkered with these CPI measures and how they're probably even higher. And John Williams of shadowstats.com has done a good job of that. He looks at how they used to calculate it in the 80s and 90s and how it would be a lot higher now. And you even have something called hedonics. So car prices, for example, haven't gone anywhere in the last 20, 30 years. Well, up until recently, even though the price went up. What they've done, they've said, well, the cars have a lot more like gadgets and they run better. And so and so. So we're gonna actually, $30,000 worth of car now is like $15,000 worth of car 30 years ago. Say don't change the price. So you get the gist there. So yes, that 2% target is just a fallacy, because all it does, it hurts the bottom 90%, not of the people, and it hurts massively the bottom 50%. And why is that? Well, because in an inflationary environment, the very wealthy are able to protect their assets. Well, they have assets. The bottom 50% have hardly any assets, so their wages get debased massively because of inflation, while the very wealthy as well, the other thing they have in their favor is that they have a say. They lobby Congress, they lobby politicians, they support the right people to go there and make sure that the tax rules and are all in their favor. A lot of these people, of course, don't pay as much tax as they should because the system is rigged in their favor. There's a lot of offshore tax situations. There's like limited liability companies. You can deduct taxes from expenses. You can buy a private jet. You've got no tax on dividends. So it's all geared towards favoring the very wealthy. And am I saying we should go back to socialism, take from the rich? No, I'm going to tell you what we should do to actually stop inflation, because that's the whole problem. So now I'm going to show you how this has affected the wealth inequality in the last 34 years. And I'm going to use data from the Board of Governors of the Federal Reserve System. And I'm going to put a link to this below in the description, and you can look at the data. It's quite amazing. And this one is the distribution of financial accounts, and its distribution of household wealth in the US since 1989. And I'm looking at wealth in general, and wealth by wealth percentile group. And I'm going to show you how this inflation has actually favored the very wealthy, and it's really hurt the bottom 50% massively, but also the bottom 90%. And that's why we see what we're seeing today out there in terms of social unrest. Am I saying it's right? No, but it's a mess. And you're going to get a lot of people, politicians, saying that what you need is to tax the rich, this and this. And it might make sense, but the fundamental reason is because of inflation. Taxing the rich, of course, sounds right because they've benefited from this inflation, but it's not going to help society in general. It's a tough spot to be. So what this means is that countries like the United States, the UK, they're becoming more and more like third world countries, like a country like Brazil, where I grew up, where there's been inflation for eons, and that's why you have so much wealth inequality. And this, of course, has been accentuated, this inflation, since 1971, when President Nixon took the dollar off gold. So let's look at the data, and I've written it down here. And you, as I said, you can also look at it. So this goes back to the third quarter of 1989, and total household wealth in the U.S. was $20.42 trillion. The top 1%, they owned $4.63 trillion of that wealth, which was 22.67%. The bottom 90 owned 40%, or 8.17 trillion. The top 10, where you add the top 10, they owned 59.9%, and the bottom 50 owned 770 billion, which was 3.77%. And I've been looking at these data for the last few years, and I've noticed that the Fed actually added the top 0.01% of households in terms of wealth percentile. And back in 1989, they had 1.75 trillion of wealth, which was 8.57%. The bottom 50% owned 3.77%. So the top 0.1% owned 2.27 times the wealth of the bottom 50%. But now we're coming back to the present. We're coming to the present. The data, the latest data is for the first quarter of 2023. So yes, household wealth has gone up massively. It's 140.58 trillion. I would argue that a lot of that is inflationary. It's not real wealth. A lot of that could evaporate very quickly. But anyway, let's look at the comparison, though, how inflation, in my opinion, has really hurt not just the bottom 50, but the bottom 90. So let's start with the top 0.1% this time. Well, now they have 18 trillion in wealth, which is 10 times more than they had back in 1989, and that's now up to 12.8%, while the bottom 50 now, they own 3.44 trillion. Yeah, that's gone up about 5 times from 0.77, so hasn't gone up as much. So now the top 0.01%, they own 5.24 times more wealth than the bottom 50%. And the bottom 90%, they own 43.53 trillion. That, of course, includes the bottom 50. That's 30.96% of all the wealth. Back in 1989, the bottom 90 used to own 40% of the wealth. Doesn't sound like much. It's almost a 10% difference. So what about the top 1%? Well, they're up to 43.95 trillion, which is 31.26% of the wealth, almost a third of all the wealth. Back in 1989, it was that proportion was 22.67. So I would say the bottom 50 has really fallen behind massively, and the top 10, the top 0.1, the top 1%, they've done quite well. So that's because of inflation, and that's why I think there's a lot of division out there. And the same thing is happening here in the UK. And we've seen these stories lately of young people protesting in the big shopping areas, not just here in London, but in the US, looting. I think it's got a lot to do with this. Am I saying they're right to do that? No. I saw a tweet yesterday of some person, economist here in the UK, saying, "Oh, we need to invest more to help children do things like sports and do that and that." Well, by that she meant more government interference. My view on that is that it's up to the parents to bring up their children and to invest in their children and look after them and make sure that they're well behaved, not the state. But at the same time, I think it's a symptom of this because we're seeing a lot of conspicuous wealth out there, and this inflation as well is reflected nowadays in all the ostentatious, conspicuous consumption of the 0.01%, and all the private jets and all the huge estates, yachts. Am I saying that's wrong? No, but it kind of creates resentment from actually not just the bottom 50, but also the bottom 90%. And having lived quite a long time, seeing things how they were in the 70s and 80s, it wasn't as ostentatious, and you didn't see as much conspicuous consumption as you see today. So I think that's what inflation does. So what's the solution to inflation? And you might say, oh, we need to have some inflation. Well, inflation is the creation of currency and credit out of thin air with no backing of a reserve asset like gold or silver. And I would argue that gold and silver are also currency, not just money and currency. So what we need is 100% 100% gold and silver system. Yes, there will be credit in that system, but it will be backed by gold, and there will be a limit to how much you can lend. You won't be able to inflate it as much. You won't be able to have a central bank that bails out the banks and the governments and creates all this funny currency and credit out of thin air. Yeah, we have to go back to a world where there is no central bank, and as the U.S. Constitution says, gold and silver are money. And I'm going to give you an example here. I'm going to show you how it has happened in the past, and it should happen again if we want to go back to a world where the money and the currency are relatively stable. Yes, I'm not saying it's going to be fixed to anything, but historically, gold and silver have always maintained their purchasing power. Yeah, it might fluctuate against different goods and services and products annually, but over the long term, they maintain their value. The other thing we don't need is legal tender laws, because people might even want to use gold and silver coins from other countries. And they did in the United States up until the Civil War, before they brought the legal tender laws. So this is how it would work. Here you've got a silver dollar. So that's currency. You would probably use that daily for probably a pretty good value transaction. And then you have a $50 silver, 90% silver, of course, the US coinage. Then you have a quarter and a dime. That would be circulating. And the only, you can't inflate that. And that's what the government is supposed to do, to make sure that the coin of the realm, or coin of the United States, has always the same amount of silver. And the thing is, if the government starts taking away the silver and putting copper and nickel, that is inflation. And that's what they've been doing, unfortunately, for the silver since 1965. And then you go to gold as well. And gold, of course, historically has had a ratio of 15 to 16 to 1 versus silver. So that means you need about 15 of these silver dollars to get just one gold dollar. So you could buy quite a bit with a gold dollar, and I'm not sure if they circulated a lot. I think the silver circulated more. And here you have a $5 gold piece. So that's a half eagle, because the eagle is $10. And then you have the double eagle, which is $20. So of course you might not carry this around. You might save this. This would be for a big transaction. Something, if you go out and buy, I don't know, a nice suit and a pair of shoes or something else, or a new refrigerator, and this would be for everyday, normal purchases, for taking the train, or for buying a coffee or whatever. So that's how it would work. But yes, there would be no inflation. The only inflation that would happen would be the economy growing, more silver and gold discoveries, the country earning more foreign reserves in gold and silver. Yes, that would inflate the money supply with gold and silver, but the economy would keep up with it, so prices would remain remain fairly steady. And historically, that's what gold has done so well. And that's why in the past, after crises that the bankers actually create, like wars and famines, people always went back to the gold and silver. But unfortunately, since World War I, that's been thrown out the window, especially in Europe, but in the United States as well. It started, I would say, with the Federal Reserve being created, because that made sure that it would be possible to go to a fiat currency system. They might argue that that wasn't the objective, but I think it was. And then you had 1933, when the US went off gold domestically, so you couldn't use these anymore. You could be put in prison for using gold. It was illegal. And then in 1964, they took the silver standard. Well, it wasn't a standard, but they took the silver out of circulation. So that's how I see it. And that's why when they tell you 2% inflation is a good thing, they're not being honest with you. The only way to maintain the purchasing power of the currency is to have real money. And yes, no legal tender laws, because people wouldn't want to hold paper or pay with paper because it would be worthless, right? People would want real money. They would want to get paid in real money, and that's how it used to be. So it's been a longer than usual video. So with that, we're going to look at the markets now, see where they are. It's 9:08 a.m. London time. We've got spot gold at 19.18. It's up about $6. The low's been 19.10. The high has been 19.18. Spot silver is up 2 cents at 22.70. The high's been 82. The low 64. The stock market futures are pretty much unchanged, so I won't go through them. The currencies, sterling is up slightly, 0.25%, 127.06. We had the GDP numbers in the UK. Yes, they're a little higher than expected, but the economy is still very weak here. Yesterday, we had a big discount retailer here in the UK declare administration. I think there's going to be 12,000 jobs lost. So the economy is not doing that great. We're still at an anemic pace of growth. So the store was called Wilco. It's still running, but it's probably going to go out of business very soon. The euro is trading just below 110. It's up 0.1%. The dollar's down slightly versus the yen, but the yen's very weak. The dollar's approaching 145. It's now at 144.56. So it looks like the Bank of Japan is probably still printing a lot of money to keep their interest rates artificially low. And the dollar's up slightly versus the yuan at 724.64. So yeah, the yuan has weakened quite a bit of late. We'll go to the other currencies. Aussie dollar is up 0.16%, 65.25. The dollar is down slightly versus the Canadian dollar, 134.41. And the Kiwi dollar is virtually unchanged, trading at around 60.10. To the general commodities, we got WTI crude at 82.52. It's up slightly. Brent as well, up slightly at 86.21. US nat gas is up 1% at 284. Platinum is up $5, trading around 915. And high-grade copper is down 1% at 375. So high-grade copper having a tough time getting back above 4, which points to a slowing economy, not just in the US, but also probably China a little bit, even though the Chinese economy is still growing like at 4 to 5%. Let's finish off with the bond market. The 10-year yield is up 1 basis point. It's trading at 4.10. In the UK, the 2-year gilt yield is just above 5 at 5.01. So with that, I'm going to wish you all a very good weekend. Take care. Bye.